Welcome back, everyone, to the Deep Dive.
Glad to be back.
Now, today we're diving into Balaji Amines Ltd.
Hooray.
And this company has really caught my eye recently. I mean, their Q2 FY25 results are, well, frankly, a little perplexing.
Oh, yeah. How so?
Well, on the one hand, they're posting these record profits.
Well, sounds good so far.
Right, but then on the other hand, their revenue growth, it seems to be slowing down.
Ah, I see. That is a bit of a head scratcher.
Yeah, and then to top it all off, it turns out that this chemical company also owns and operates a five-star hotel.
A five-star hotel, huh? Now, that's not something you see every day.
I know, right? It definitely adds a whole new level of intrigue to this deep dive.
Well, sometimes the most unexpected details can be the most revealing ones, right?
Exactly. So let's start by unpacking the basics. Balaji Amines is the largest manufacturer of aliphatic amines in India.
Mm-hmm.
Now, full disclosure, I'm not a chemist, so could you break down what exactly aliphatic amines are and why they matter?
Sure. So think of them as these tiny but powerful chemical building blocks. They're essential for creating a huge range of products from pharmaceuticals and agrochemicals to get this rocket fuel.
Wait, rocket fuel? Seriously?
Yep, you heard that right. Rocket fuel, among many other things.
Okay, well, now you've definitely got my attention. So these chemicals are clearly in high demand, which makes that revenue slowdown we talked about even more puzzling.
Yeah, and to understand that, we need to zoom out a bit and look at the bigger picture. The global amines market is a $4.9 billion industry dominated by just a handful of major players.
An oligopoly.
Precisely.
Yeah.
And while that means they have the potential for high profit margins, it also makes them vulnerable to any kind of disruption.
Disruption? Like what?
Oh, supply chain issues, sudden changes in demand, even global events can throw a wrench in things.
Yeah, that makes sense. So even though the pharmaceutical and agrochemical industry, there are other factors at play here.
Absolutely. Now, before we get too deep into the numbers, maybe we should address the elephant in the room, or rather the hotel in the balance sheet.
You mean their luxury hotel, the Balaji Sarovar Premier?
That's the one. It's not every day you see a chemical company running a five-star hotel.
Definitely not. So what's the story there?
Well, we'll dig into the specifics later, but for now, let's just say it adds an interesting layer of diversification to their portfolio.
Okay. Diversification makes sense. It's like they're hedging their bets. Rocket fuel today, luxury accommodations tomorrow.
You got it.
But before we get lost in a world of plush bathrobes and room service, let's go back to the basics. Balaji Amines has been in the news recently for their ambitious Greenfield project, which is a major expansion plan that's key to their future growth.
Right, but as with any large-scale project, it hasn't been without its challenges.
Oh, what kind of challenges?
Well, there have been some delays, which could be contributing to that revenue puzzle we're trying to solve.
I see, but they did have one recent win, right? Their new methylamines plant went live ahead of schedule.
Yeah, it did. They actually commissioned it in November 2024. And that's a big deal because it gives them a cost advantage in producing a key ingredient for many of their products.
How so?
Well, they're using indigenous technology, which means they're not relying on expensive foreign imports or licenses.
Ah, so they're controlling their costs while also expanding their production capacity.
Yeah.
That's a smart move in such a competitive market.
Definitely. Now, speaking of smart moves, there's another project that really piqued my interest, their upcoming dimethyl ether plant.
Oh, yeah, I read about that. What's so special about it?
Well, dimethyl ether, or DME, can be used as a substitute for LPG.
LPG, as in the liquefied petroleum gas that many people use for cooking and heating.
That's right. So if they can successfully bring this plant online and DME catches on, they could tap into a massive new market.
Wow. Now, that would be a game changer.
It certainly has the potential. So, yeah, they're clearly not afraid to innovate and think big.
Okay, so we've got a company with a strong position in a growing market. They're expanding their production, they're venturing into new areas, but their revenue growth is slowing down, and we still need to understand why.
You're right. The investor presentation provides some context and insights into their strategy, but to really get to the bottom of this, we need to dive into those financial statements.
All right, let's do it. Let's see what those numbers have to say.
Sounds good to me.
Now, first things first, we need to understand the difference between Balaji Amines standalone and consolidated financial results.
Okay, so the standalone figures represent the performance of Balaji Amines itself, while the consolidated results include their subsidiary, Balaji Specialty Chemicals Limited.
Gotcha. So the consolidated results give us a more complete picture of their overall business.
Exactly. And as we'll see, the subsidiary is playing a pretty significant role in their recent performance, but it also adds another layer of complexity to the analysis.
Well, challenge accepted. Let's start by examining their revenue. I noticed that both their standalone and consolidated revenue dipped slightly compared to the previous quarter.
Yeah, you're right. Standalone revenue came in at 326 crore rupees for Q2 FY25, while consolidated revenue was 356 crore rupees. Both represent a slight decrease from the previous quarter.
But what really stands out is the year-on-year comparison. Consolidated revenue is down 13% compared to the same period last year.
That's a pretty significant drop.
It is, and it suggests that something more than just seasonal fluctuations is at play here.
Agreed. We need to dig deeper to understand what's driving this decline.
Okay, but before we get too gloomy, let's look at their profitability. And here's where things get really interesting. Despite the dip in revenue, their consolidated profit is actually up significantly year on year.
You're right. Their consolidated profit after tax, or PPAY, is 41 crore rupees for Q2 FY25. That's a 21% increase compared to the same period last year.
So their profits are soaring even though their revenue is declining. This is where I get a little lost in the financial jargon. Can you help me understand what's going on here?
Sure. To understand this, we need to look at a key profitability metric called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization.
EBITDA. Okay, and what does that tell us?
Essentially, it gives us a measure of a company's operating profitability.
So higher EBITDA means they're making more money from their core operations.
Exactly. And in Balaji Amines' case, their consolidated EBITDA for Q2 FY25 is 70 crore rupees, an 18% increase compared to the same period last year.
So it seems like there are two different stories playing out here. On the revenue side, we see some potential challenges. But on the profit side, they're firing on all cylinders.
Makes you wonder what's happening behind the scenes, right?
Exactly. And that's why I'm so eager to dive into that investor presentation. It's not just about the raw numbers, it's about understanding the narrative behind them.
You got it. The investor presentation gives us context insights into their strategy clues about what the future might hold.
All right. Let's see what they have to say. The presentation starts with an overview of the amines industry. They emphasize the global nature of the market and their strong position within it.
Right. They highlight that they export to a wide range of countries, with Europe being a key market, accounting for 45 to 55% of their export revenue.
Which, as we discussed earlier, also comes with risks.
Yep. They acknowledge that they're exposed to geopolitical factors, currency fluctuations, potential supply chain disruptions. And let's not forget their reliance on imported methanol, a key raw material that's subject to price volatility.
So, lots of potential headaches to manage.
For sure. But the presentation also showcases their strengths. They emphasize their focus on developing indigenous technology.
Right, which allows them to control costs and adapt quickly to changing market conditions.
Exactly. They're not reliant on expensive foreign technology or expertise, and they're not afraid to invest in innovation either. They highlight their commitment to R&D, which is evident in their pipeline of new products.
They mentioned a few exciting developments, including electronic-grade DMC for EV batteries.
Yeah, they're clearly positioning themselves to capitalize on emerging trends.
So they're navigating a complex and challenging market, but they're also making strategic moves to secure their future.
And let's not forget about their subsidiary Balaji Specialty Chemicals.
Right. The presentation highlights their rapid expansion and their focus on even more specialized chemicals.
They even received mega project status from the Maharashtra government, which gives them access to various incentives and support.
Wow, that's a big deal.
It is, and it's likely playing a major role in their strong profit performance.
Okay, we've covered a lot of ground, but there's still so much more to unpack, especially those detailed financial statements. I'm ready to roll up my sleeves and dive into those balance sheets, cash flow statements, and all the nitty-gritty details.
All right, let's do it. The numbers will help us separate the signal from the noise and gain a deeper understanding of Balaji Amines' true financial health.
Sounds good to me. Let's get started.
All right, so let's start with the standalone balance sheet. This focuses solely on Balaji Amines itself, excluding their subsidiary.
Yeah.
It provides a snapshot of their assets, liabilities, and overall financial structure as of September 2024.
Perfect. I'm ready to decode this financial snapshot. What's the first thing that jumps out at you?
Well, their total assets are valued at 1741 crore rupees. That's a modest increase from 1736 crore rupees in March 2024. So they've grown their asset base slightly over the past 6 months.
All right, so steady growth. What are some of the major items we see here?
Well, as you might expect from a manufacturing company, their largest asset category is property, plant, and equipment.
Right, that includes their factories, machinery, all those tangible assets that keep production humming.
Exactly. And in September 2024, it was valued at 715 crore rupees.
Okay.
Interestingly, that's actually down slightly from 719 crore rupees in March.
Hmm. A decrease in property, plant, and equipment.
Yeah.
What could explain that?
Well, it could be due to normal wear and tear depreciation, which accountants factor in to reflect the declining value of assets over time.
Right.
Or they might have sold off some older equipment as part of their modernization efforts.
Interesting. It's like they're trading in their old clunker for a shiny new sports car.
Now, what about those big expansion plans they keep talking about? Shouldn't we see that reflected somewhere in the balance sheet? You're absolutely right. And that's where capital work in progress comes in. This category represents investments in ongoing projects.
Gotcha.
And for Balaji Amines, it's a significant chunk of their assets.
How significant are we talking?
The capital work in progress is valued at 214 crore rupees in September. This includes their greenfield expansion. And remember, they're also building a solar power plant, which is a smart move for both cost savings and sustainability.
So they're putting their money where their mouth is when it comes to growth. Now let's flip the balance sheet over and look at the liability side. What are their major obligations?
Well, the biggest liability category is other equity, which stands at a whopping 1,573 crore rupees.
1573 crore. Okay, now, other equity might sound a bit mysterious. What exactly does that include?
It's essentially a catch-all term that includes retained earnings reserves and other equity accounts that aren't part of the company's share capital.
Okay, so it's basically a measure of the value that's been accumulated within the company over time.
Exactly. And the fact that it's increased from 1538 crore rupees in March is a positive sign. It suggests they're reinvesting their profits back into the business, which fuels further growth.
Ah, the virtuous cycle of business. Now, what about debt? How much are they borrowing to finance all these ambitious projects?
That's where it gets really interesting. Their financial liabilities, which is essentially their debt, is a mere 1 crore rupee.
1 crore. That's practically nothing.
It is. This low debt level gives them a lot of financial flexibility and makes them less vulnerable to interest rate hikes or economic downturns.
It's like they've got a financial safety net in place. Okay, I think we've squeezed all the juice out of the standalone balance sheet. Now let's broaden our view and take a look at the consolidated balance sheet, which brings their subsidiary into the mix.
Great idea. This will give us a more complete picture of their overall financial position. As of September 2024, their total consolidated assets stand at 2,153 crore rupees,
Okay.
a slight increase from 2,126 crore rupees in March. So similar to the standalone balance sheet, we see steady but not explosive growth.
Steady and stable. That's not a bad thing, especially in today's unpredictable world. Now, with the subsidiary included, how does their asset breakdown change?
Well, just like in the standalone balance sheet, their largest asset category is still property, plant, and equipment, but the number is significantly larger, coming in at 882 crore rupees.
Of course. We're now factoring in all of the subsidiaries' factories, machinery, and other tangible assets. But I'm noticing a pattern here. This category is also slightly down compared to March.
You've got a sharp eye. And again, the reasons could be depreciation or the sale of older assets.
All right, what else stands out in the consolidated balance sheet?
Their capital work in progress is a whopping 283 crore rupees.
Wow.
Remember, this includes both Balaji Amines investments and these of their rapidly expanding subsidiary.
Right, and this number is up significantly from 203 crore rupees in March, which tells us they're aggressively investing in growth. Now let's shift our attention to the liabilities side of the consolidated balance sheet. Any surprises there?
Their largest consolidated liability is, again, other equity, which comes in at 1764 crore rupees in September.
Okay.
This is up from 1716 crore rupees in March, further reinforcing the idea that they're plowing their profits back into the business to fuel future growth.
Okay, that's consistent with what we saw on the standalone balance sheet. Now the million-dollar question. How much debt are they carrying at the consolidated level?
Drum roll, please. A minuscule 6 crore rupees in borrowing.
Seriously, they're practically debt-free. It's like they're allergic to borrowing money.
It's certainly a testament to their financial discipline. They're clearly prioritizing stability and self-reliance, which are valuable traits in any business, especially in a cyclical industry like chemicals.
Okay, I'm starting to see a clear picture of their financial strategy. Conservative, cautious, and focused on long-term growth. But balance sheets only tell part of the story. Let's move on to cash flow. After all, cash is king, as they say.
Absolutely. Cash flow statements show us how a company generates and uses its cash. It's a dynamic view of their financial health. Let's start by analyzing the standalone cash flow statement for the 12 months leading up to September 2024.
Sounds good. Give me the highlights.
First off, their profit before tax, the starting point for calculating cash flow was a solid 109 crore rupees. After factoring in non-operating items, their operating profit before working capital changes comes to 123 crore rupees.
Okay, so they're starting with a healthy profit base. Now, working capital can be a bit of a head scratcher. Can you remind me what that is and how it affects cash flow?
Think of working capital like the cash a company needs to keep the lights on and operations running smoothly. It includes things like inventory accounts, receivable money they're waiting to collect from customers, and accounts payable money they owe to suppliers.
Right. So changes in these areas can either boost or drain a company's cash flow.
Exactly. And in Balaji Amines' case, changes in working capital had a negligible effect on their cash flow during this period. So their cash generated from operations before taxes was essentially the same as their operating profit, 122 crore rupees.
Not bad. They're generating a healthy amount of cash from their core business activity.
Indeed. Now, they did have to pay 19 crore rupees in direct taxes, but even after that, their net cash flow from operating activities was a very healthy 103 crore rupees.
Okay, so their core operations are a cash-generating machine, but they're also investing heavily in growth, right?
Yeah.
What does their cash flow from investing activities tell us?
You hit the nail on the head. Their cash flow from investing activities was negative 68 crore rupees. The minus sign simply means that they spent more cash on investments than they received from selling any assets.
Makes sense. They're building new plants, upgrading equipment, all those things we saw reflected in the capital work in progress on the balance sheet.
Precisely. Now, what about financing activities? This category covers things like issuing new stock, taking on debt, or paying dividends to shareholders.
Right. Those activities can also impact a company's cash position. So what's the story here?
Well, their cash flow from financing activities was also negative at 37 crore rupees. This mainly reflects dividend payments to their shareholders.
Okay. So they're rewarding their investors while simultaneously investing in growth. That's a balancing act many companies strive for. Now, the bottom line, how did all these cash inflows and outflows impact their overall cash position?
Their cash and cash equivalents at the end of the period, September 2024, stood at 29 crore rupees. This is down slightly from 31 crore rupees at the beginning of the period.
So despite generating positive cash flow from operations, their overall cash position dipped a bit due to those investments in growth.
Exactly. They're strategically using their cash to fuel future expansion, which aligns with their ambitious plans.
Now let's turn our attention to the consolidated cash flow statement, which includes their subsidiary. I'm curious to see how those numbers stack up.
Good point. The consolidated cash flow statement tells a slightly different story. Their consolidated profit before tax was 118 crore rupees for the 12 months ending in September 2024. After adjustments, their operating profit before working capital changes reached 134 crore rupees.
Oh, okay, so their starting profit is even higher when we include the subsidiary. What about those working capital changes this time around?
This is where it gets interesting. Changes in working capital actually contributed positively to their cash flow, adding 82 crore rupees.
Wait, a positive impact from working capital changes? That's not what we saw in the standalone statement.
Exactly. This suggests that they're managing their inventory, receivables, and payables very efficiently at the consolidated level.
So they're getting even more cash from their operations because of how they're managing these short-term assets and liabilities. Impressive.
It is. Their total cash generated from operations before taxes comes to a remarkable 216 crore rupees. After deducting 21 crore rupees in direct taxes, their net cash flow from operating activities was a stellar 195 crore rupees.
Wow, their subsidiary is really adding some serious muscle to their cash-generating abilities. Now, what about investing activities at the consolidated level?
Similar to the standalone statement, their cash flow from investing activities was negative, but this time it was a larger outflow, 81 crore rupees.
Of course. We have to remember that their subsidiary is also undergoing a major expansion requiring significant investments.
Exactly. Now let's move on to their financing activities.
All right. How do they manage their financing during this period?
Their cash flow from financing activities was also negative at 42 crore rupees. This primarily represents dividend payments and repayment of borrowings.
So they're sticking to their strategy of rewarding shareholders while also maintaining low debt levels. Now, the big reveal, what's the net impact on their consolidated cash position?
Their cash and cash equivalents at the end of the period stood at a very healthy 153 crore rupees. That's a significant jump from 81 crore rupees at the beginning of the period.
Wow, that's a huge increase in their cash reserves. It seems like their investments in growth are already starting to pay off in terms of increased cash generation.
You got it. They're in a strong financial position to execute their plans. Now, I know we've been crunching a lot of numbers, but I think it's important to step back and remind ourselves what these numbers actually mean.
You're right. It's easy to get lost in the spreadsheets and forget the bigger picture.
Exactly. Remember, financial statements are just a tool, a snapshot in time. They don't tell the whole story. We need to consider the context, the industry dynamics, and the company's overall strategy.
You're reminding me of something we talked about earlier, the global nature of the amines market and the various risks and opportunities that come with it.
That's right. The investor presentation highlighted Balaji Amines' global reach, with a significant portion of their revenue coming from exports. They're selling to customers in Europe, the US, Japan, and many other countries.
Which, as we discussed, exposes them to things like geopolitical risks, currency fluctuations, and potential supply chain disruptions.
And let's not forget their reliance on imported methanol. They're vulnerable to price swings in this key raw material, which is largely sourced from the Middle East.
Okay, so it sounds like a bit of a tightrope walk, balancing these external challenges with their internal strengths.
Exactly. But remember, they're not just passively riding the waves, they're actively managing these risks and making strategic decisions to position themselves for success.
Right, they're investing in indigenous technology to reduce their reliance on expensive imports and gain a cost advantage.
And they're constantly innovating, developing new products, and expanding into new markets, like that potentially game-changing dimethyl ether project we discussed earlier.
Okay, I'm starting to see the full picture. A company with a solid financial foundation, a clear vision for growth, and a willingness to take calculated risks. But we still have one more piece of the puzzle to examine: their intriguing foray into the world of luxury hotels. I'm ready to check in and see what's happening at the Balaji Sarovar premiere.
Let's do it. It's time to trade our calculators for fluffy bathrobes and explore the world of five-star hospitality.
Okay, so we're switching gears now from spreadsheets and chemical equations to something a little more glamorous. Balaji Amines' venture into the hospitality industry.
Quite a contrast.
It is, I have to admit, the idea of a chemical company running a five-star hotel still kind of throws me for a loop.
I get it. It is an unusual pairing, but remember, we're always looking for those hidden clues about a company's overall strategy.
Right.
And this unexpected move could actually be a really savvy business decision.
Okay, I'm listening. Convince me. Why would a chemical company want to diversify into the hotel business?
Well, for one, it creates a new revenue stream that's less dependent on the ups and downs of the chemical industry.
A hedge against those market fluctuations.
Exactly. Think of it as a backup generator for their business.
So if the demand for rocket fuel suddenly plummets, they've still got guests checking into their luxury suites.
You got it. And let's not forget about the potential synergies. A well-run hotel can actually enhance a company's brand image.
Oh, I see.
It creates opportunities for networking and business development.
Yeah, they could be wining and dining their international clients in style, impressing them with their chemical expertise, their hospitality skills.
Precisely. Now let's get into the specifics. Their hotel, the Balaji Sarovar Premier, is located in Solapur, and it's actually a joint venture with the Sarovar Group.
The Sarovar Group.
Yeah, they're a well-known hotel management company.
So Balaji Amines isn't trying to become hoteliers overnight. They've partnered with experts to handle the day-to-day operations.
Smart move. And based on the numbers, this partnership seems to be working really well. The hotel boasts a 67% occupancy rate.
67%. That's pretty impressive for the hotel industry.
It is. It suggests they're attracting a steady stream of guests.
So they're not just filling rooms, they're actually running a successful hotel. What about their financial performance? Is this hotel actually making money?
It seems so. The investor presentation highlights their strong average room revenue.
Average room revenue. Okay, what does that tell us?
It basically means they're pricing their rooms well and managing their costs efficiently.
So this isn't just a vanity project. It's a legitimate business venture that's contributing to their bottom line.
Exactly. And they're not stopping there either.
Oh, really?
What are they planning?
They're actually planning to expand the hotel by adding 40 more rooms.
40 more rooms. Wow, they must be seeing some real potential for growth in this market.
They definitely are. And who knows, maybe they'll even consider replicating this model in other locations.
Yeah, that would be interesting to watch. It's like they've discovered this hidden talent for hospitality.
It really is.
Who knew that a company known for producing these essential but kind of behind-the-scenes chemicals could also create a luxurious and welcoming environment for travelers?
It's a great reminder that businesses are constantly evolving, adapting to new opportunities, and sometimes those most unexpected ventures can lead to the greatest successes.
Well, this deep dive has certainly been full of surprises. We started with a seemingly simple analysis of financial statements, but we ended up exploring everything from rocket fuel to luxury hotels.
And don't forget about those intriguing cash flow statements. Oh yeah, those were quite the journey.
It just goes to show the complexity and interconnectedness of the business world.
Absolutely. So for our listeners who've been with us on this adventure, what are the key takeaways from our deep dive into Balaji Amines?
Well, first and foremost, Balaji Amines is a company that's clearly not afraid to think outside the box.
They don't shy away from a challenge.
Nope. They're leaders in the Indian amines market, but they're also exploring new avenues for growth and diversification.
And they're doing it all while maintaining a really solid financial foundation.
Right. They've got a strong track record of profitability, a conservative approach to debt, and they're clearly committed to innovation.
Investing in indigenous technology, developing those new products, and expanding into new markets. Like that dimethyl ether project that could really shake things up.
It could. And let's not forget about their commitment to sustainability and social responsibility.
Yeah, they're walking the walk with those investments in renewable energy and their focus on ethical business practices.
But it's important to remember they are operating in a complex and constantly changing environment.
Right. The global amines market is full of risks and uncertainties.
And their reliance on imported methanol makes them vulnerable to things like price fluctuations and supply chain disruptions.
We can't forget about that foray into the hotel business. While it has the potential to be really lucrative, it also adds another layer of complexity to their portfolio.
Definitely. So while Balaji Amines has a lot going for it, it's crucial to keep an eye on their progress.
To see how they navigate those challenges.
Exactly. So to our listeners, keep those financial statements handy and stay tuned for what the future holds for Balaji Amines.
Well said. Thank you for joining me on this deep dive. It's always a pleasure to explore these fascinating companies with you.
Likewise, thanks for having me.
And to our listeners, keep exploring, keep learning, and as always, we'll see you next time on the Deep Dive Dirt Up.